Hi, this is Michael Jones, Chairman and Chief Executive Officer of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets and economic events. Let's get started. So, everyone who knows me well has been wondering, when am I going to bring a whiteboard into these Market Insights video? Well, wonder no more, it's this week. And the reason I'm bringing in a whiteboard is I've got some questions about last week's video, and specifically I mentioned price earnings ratios, or PE ratios, as an important metric for determining whether the stock market is over or undervalued. And people were saying, well, what is a PE ratio and why does it matter? So we thought we would tackle that this week. So price earnings ratio, as the name suggests, is the price of the stock over the earnings per share of the stock. So if you think about, if the price of a stock is 20 and it earns $1 a share, then the price earnings ratio equals 20, right? If the price is 10, then and it's still earning $1, then the price earnings ratio is 10. Pretty simple. And it's important to understand that when you talk about that $1, you might say, well, why would I pay 20 times the earnings of the company? I mean, essentially, for every dollar of earnings from the company, I'm paying $20. How's that fair? Well, the answer is you're not getting just 1 year's worth of earnings. When you buy a stock, you get this year's earnings and next year and the year after and the year after and all the way out into time. And that's important because obviously that's a lot of years, and there's a lot of $1 sitting out there in the future for you. It's also why interest rates are really important in determining the right value or the right PE for the market. But that's a future Market Insights. Now, another thing that you may find confusing is you can hear people say that the S&P 500, the big market index, it's at 20 times earnings. No, it's not. It's at 30 times earnings. No, it's at 25 times earnings. You're like, what's going on here? Why are there all these numbers flying around? And the answer is that there are 3 commonly quoted PE ratios, and they don't always tell you which one they're talking about at a given point in time. So let's talk about those 3, make sure that we understand them, because they're pretty simple to understand. All right, the first one is what we call trailing 12-month PE. All right, so T12, all right? What this means is that the price, and by the way, this is the good part, the price never changes. The price is just the price. So the price is 20. The earnings that are underneath are the earnings for the last 12 months. They're in the rearview mirror. You don't have to guess about them. You don't have to wonder. And that's the great thing about this particular PE. There's no guessing here. You know the price. You know what the last 12 months earnings are. You know that you're paying 20 times earnings. All right? But people say, well, wait a minute, I don't buy a stock because of current earnings. I'm buying those future earnings, and I expect those earnings to grow. So a very common PE that is quoted is the so-called forward PE. All right, what does that mean? Well, we know the price, it's $20, but it's not the last 12 months earnings. It's what I expect, what I guess the next 12 months earnings will be. All right, and that might be, say it's like 1.2. All right, so the point of this is that this 1.2 is what I am guessing, or what typically is the case, is they take an average of all the stock analysts on Wall Street and they say, what do they think earnings are going to be? So if the price is still 20, but we are going to value it based upon what the average analysts think next year's earnings are going to be, that's 1.2. And so the PE is not 20, which is trailing 12, it's about 16.7, which is what we think forward 12 months earnings are going to be. There is one last PE that gets quoted a lot, and that is what's called the cyclically adjusted PE, or CAPE. And this was invented by a guy named Robert Shiller at Yale University, so it's also called the Shiller PE. And Shiller looked at these and he said, well, wait a minute, I don't like this, because this trailing 1 year earnings, I mean, it might have been a particularly great year or a particularly bad year. What does 1 year's earnings tell me? And next year's earnings, hey, analysts are wrong about that all the time. I want a more stable way to look at valuation. And so what he decided we would do is we would start, obviously the price is still the same, but he would take the average earnings over the last 10 years. And that average earnings over the last 10 years, let's say we'll make the math easy, and it's 50 cents. So the cyclically adjusted PE is 40. All right, so the price is always the same, but depending upon whether you use the last year's earnings or what we hope next year's earnings are going to be, or the average of the last 10 years' earnings, you can get very different numbers. And so when you get a PE ratio, it's important to understand what is the earnings that they're using. Now, one other thing we ought to talk about, and as I said, that when you buy a stock, you're not just buying this year's earnings and next, all the way out in time. And there will be some stocks, when you see their PE ratio, you'll think somebody has made a mistake here, because the number isn't 20 or 16 or 40, it's 400 or 800 or 1,000. When you're talking about companies like DoorDash and Netflix and Tesla, the PE ratios look wild, and something like you're like, am I misinterpreting something? Is something going on? And the answer is no. But what the market is saying when you see these crazy big PEs is that they believe that next year's earnings isn't going to go from 1 to 2. Oh no. Next year's earnings are going to go from 1 to 4. And then after that, they're going to go to 8. In other words, they expect massive, rapid growth in these stocks. Now, if you get that kind of massive growth, the way that Amazon has done for the last 20 years, because it's traded at PEs that everybody said, oh my gosh, how could they ever grow that fast? Well, they did. So if these companies grow as fast as is expected, then you can make the kind of money you made in Amazon. On the other hand, Yahoo 20 years ago was trading at these kind of crazy valuations, and it didn't grow earnings, and people lost a lot of money. So valuation based on PE is an indication of how fast the market expects earnings to grow. If earnings come in with expectation or better than, you make money. But the higher the PE you buy, the more you're betting that the future growth is going to be good, and the more risk you take that if you're disappointed, you lose money. Thanks for joining us for Market Insights. We hope you found it helpful. If you'd like to see other research pieces that we produced, you can look at our website, caravelconcepts.com, or you can subscribe at the link below. Thanks so much.